All right, it is tax season, and every year investors ask the same questions. So I'm going to break them down in this video, at least the most popular ones. Hey, what's going on, everyone? This is Mal Vodi with financiallypresent.com, your one-stop shop for financial and investment education. And since it's tax season, we are going to break down some of the most popular or most common questions that tax preparers are going to ask. And tax preparers, in this sense, I'm talking about you as an investor. Sometimes you prepare your taxes on your own. Sometimes you refer to a CPA or an accountant. I want to make sure that when you are listening to this information, you are working in accordance to the IRS rules and whoever files your taxes for you. So your CPA or accountant. This is all for educational purposes only. But in my experiences, there are all types of common questions. You're going to get papers in the mail. You may or may not be familiar with them. You're going to see a 1099, Form 5498, Form 8606. You're going to hear things like qualified dividends and capital gains and capital losses. What do all of these mean? We're going to break all of that down. First, I'm going to talk about the more taxable side. So individual joint accounts, we'll handle those. And then we'll talk about more of the IRA stuff. So individual retirement account and Roth IRA account. Let's get it. Starting off with our taxable accounts. Question number one. I didn't sell any stock. Can I just file? What should I do? Well, you may or may not need to wait for your 1099 form, but in my opinion, you should. Okay, when you get dividends over $10 worth, you should expect to file your 1099 form with your taxes. You can also expect to see certain things like, for example, if your stock was purchased by another company, like a merger or acquisition, or if a stock was taken private. The stock you owned is no longer being publicly traded and they've redeemed your shares for you, so you've been given cash. Those would be reasons to use your 1099 form when you file. And your 1099 form can come as often as each month, being revised all the way up until March, April. I've even seen some come late. So I still recommend that you wait, even if you don't feel like you've sold stock or placed enough trades to trigger taxable activity. I'd say wait for that 1099 form so you can file. Question number two. I already filed my taxes and I just got a corrected 1099. What should I do? Okay, so again, it is important to wait to file until you've received your 1099 forms. And unfortunately, some of these in different investments, they may send a corrected 1099 forms. Sometimes things get reclassified on the back end and you have to report it as a taxpayer. It may or may not affect how you file, and that's where you may need to speak to your accountant about that. I'm going to include a link in the description that you can use, and you'll be able to figure out, hey, is it worth it to file an amended return, or should you just proceed as normal? Question number three, what is a wash sale? Okay, so if you are a short-term trader or swing trader, as we like to call them, or day trader, there's a chance you're going to see a lot of this, okay? The idea is that when you sell a stock for a loss, generally you can deduct up to $3,000 worth of losses or offset some of your gains with those losses. When it comes to a wash sale, what they're saying is you have now sold a stock for a loss, and now they're going to look at the day you sold it for the loss, they're going to look at 30 days before that, and then they're going to look at 30 days after. If you have repurchased that stock within that 61-day range, they're going to take the loss of that stock and add it to the cost of the shares that you're still holding. So they've adjusted your cost basis within your account. You'll see on the back end in the accounting portion. And now you are not able to deduct that loss until you sell those remaining shares and leave them alone for 30 days, basically. So they do that to make sure that there's no bad behavior as far as taking advantage of the tax code in the wrong way. So that is the wash sale rule. They're basically calling that loss a wash until you leave that stock alone. Again, a wash sale is only for if you sell a stock for a loss. If you're selling a stock for a gain, don't worry about it. If you struggle with understanding capital gains or capital losses, check out my ebook, Essential Keys to Financial Presence Introduction to Investing, where I break down all of these different topics, and it'll help you figure some things out for sure. Okay, now let's switch over to the IRA side, or the retirement account side. Question number 1. When is the last possible time I can make a contribution for the previous tax year? Okay, so for example, if we are filing for the 2022 tax year, the filing deadline is April 18th, 2023. That is the last day you can make a deposit for a 2022 contribution. Okay, it can even be postmarked by April 18th, 2023. So as long as you're at the post office in line and it's stamped by a clerk on the 18th, you're good. That contribution can count towards that tax year. Or digital deposits or contributions made online, those can count for the 2022 tax year. As soon as it's April 19th, it's gonna count for the 2023 tax year, or they're gonna say, hey, this deposit is too late. Do you still wanna put it in your account? Yes or no? Question number 2, I contributed to my IRA last year. What do I do? Okay, so it's pretty simple. You've probably bought and sold, traded, or you're buying and holding investments in your IRA or even Roth IRA. And that's fine. When it comes to IRAs and tax season, the main concern are the contributions, the distributions, and your age, okay? Because that's where all of the rules start to come into play. Everything else is secondary, basically. You're gonna get a 5498 or Form 5498 that's gonna say, hey, you contributed this amount last year. They're not gonna really list out all of the trading. No one's concerned about that. They're concerned about money coming in, money coming out, and your age when it comes to a retirement account. Question number 3, I did a distribution for my IRA or Roth IRA last year. What do I do? Okay, so let's assume you did not withhold any taxes when you did your distribution. You have to figure out, are you over 59 and a half or are you younger than 59 and a half? If it's a traditional IRA and you're under 59 and a half, you can expect that you'll generally pay a 10% penalty unless you qualify for an exempt reason to make that distribution. And I'm gonna include an IRS link in the description that you can use. And essentially, that distribution is going to be counted as your regular earned income for that tax year, basically. If it's a Roth IRA, it's a little bit different. If it's a Roth IRA and you're over 59 and a half, you make a withdrawal from that Roth IRA, you're good to go. No questions asked, tax-free. If you're under 59 and a half, then you need to make sure that, of course, when you do that distribution, you qualify for an exempt reason to do that distribution. Otherwise, that you can see a 10% penalty that's assessed on the earnings that you've withdrawn. But if you withdraw the principal, so your regular contributions, you just decide to take it out, generally that's tax-free as well because you've already paid taxes on that amount. So there is a little bit of difference when it comes to the traditional IRA and the Roth IRA, but ultimately when you do a distribution, you can expect that it may change your income situation when you file. Question number 4, what if I did an IRA conversion or backdoor Roth IRA? What do I do? Congratulations, you make too much to contribute directly into a Roth IRA. So you essentially have to deposit into a traditional IRA and then fill out a conversion form to convert that contribution into a Roth IRA account. The benefit there is that essentially when you withdraw from your Roth IRA in the future, it's going to be tax-free. So assuming everything's been there, or that the Roth IRA is at least 5 years old, it would be tax-free. So that's a great way to have a tax-free income when you're of retirement age. Generally, when you're filing your taxes, there's a form called 8606, and that's what you would complete, and it's embedded within how you file, whether it's electronically or by paper. There are plenty other scenarios and questions that people will have during tax time, but you tend to find those the most. What are some questions that you have? Feel free to put them in the comments below. If you like this video, go ahead, hit that like button, subscribe if you're new to the page, and turn on notifications so that you don't miss out on future content. And until next time, stay present.